Good morning, everyone. Welcome to Offices Adda 24/7. My name is Niharika Valia, and I'm here with you for the topic of JAIIB AFB examination. So let's continue. Okay, before we proceed further, if you haven't subscribed to our channel yet, so please subscribe our channel, and at the same time, don't forget to download our app. That would be helpful for you in terms of latest updates, latest courses that are coming up, and many more things. So let's move forward and okay, our English medium batch is just about to start. It would be starting from today only. A new batch has been starting, and that means on 16th of August, we are just about to start with the new batch for JAIIB examination. So if you haven't reviewed it yet, kindly go ahead and check out. And at present, the if you can use the code Y541, that will give you a discount of 81%. So if you haven't gone through our courses for JIIB AFB examination yet, then kindly go ahead. The timings for this class would be morning, most probably 8 to 9. So if you haven't looked forward towards your December 2022 examination, then do not delay it, because any kind of delay would ultimately cause a trouble for you. It's way better if you start your preparation way before time. So let's quickly move on. Okay. Now, this is the first question that we can take up. The first question says that interest on loan given by a financial company is shown in the statement of the profit and loss as revenue from operations, other income, then sundry expenses, or none of the above. There's an interest on loan given by a financial company. There are two kinds of companies, financial and non-financial company. When there's a non-financial company, this non-financial company, they make their money by selling things. They make money from other areas. While a financial company puts their money in the financial instruments. Maybe they would be lending, they might be investing, whatever they would be doing. So all that money basically is shown in their um, revenue from operations. That's because their working is such that everything they are dealing with is in terms of the finances. That means they might be receiving dividends, they might be receiving interests, they might be receiving the profits because they might be selling those investments again. So there are so many things they would be dealing, but that is their hardcore work. So if it's their hardcore work, they receive money because of the RFO, right? This is their RFO, means revenue from operations, which is the basic sales for a company. Oh, interest on loan given by. No, this has to be like that only. This is given by. There's a problem in this question. It says that interest on loan given by a financial company. If it is given by a financial company, it would be a sundry. It would come under the term of finance expenses. Okay, let me just clarify this question. There are two things. If a particular company, which is basically a finance company, that for that finance company, interest on loan that they are receiving, the dividends that they are receiving, it's all a part of their main income. That is, it would be a part of their revenue from operations. While in case of a company which is non-financing, it would treat interest on loan which they might be receiving as other income. And any expense which would be paid in the form of interest, this interest paid by any of these by any of these people would be treated as finance cost. So the expenses have a different treatment and incomes have a different treatment. The treatments of all these things varies. Finance here is a financial company receiving income, and there it is basically paying it. This treatment will remain the same while this varies. Okay, now comes the next question. The balance sheet of Mr. Kapoor consists of a capital of 7 lakh, machinery of 5 lakh, and cash of 2 lakh. If he spends 5,000 to buy a bicycle for personal use, the balance sheet of the capital account will be. Now, this is more or less like accounting equation. So there you have a particular capital of 7 lakh rupees. So I'm stating 7 lakh here, right? So there is a 7 lakh amount here, and if this amount was earlier invested as 5 lakh in cash and 2 lakh in, sorry, 5 lakh in machinery and 2 lakh in cash. Now he's spending 5,000 on his personal use. So there it is. There's 5,000 being spent for his personal use. It is also going from the cash as well. Since we are losing money from the business, so where would that money go? Exactly this particular amount is taken out of the business. So there it is 6 lakh 95 here and 5 lakh plus 1 lakh 95 here. So I think that would come out to be 6 lakh 95,000. A very basic question but requires a proper knowledge. What is exactly happening with the amount that we withdraw from the business? Anything that we withdraw from the business is basically the reason behind which the capital falls or declines. But this amount is taken from the capital, but it is also going from the cash as well. So basically, when we jot down the journal entry for the same, it would come out to be drawings to cash. If you follow the journal entry, even then you'll be able to solve it. Basically, in this area, in the accounting equation, there is a, so the class might be there. Okay. Now, the capital is equal to assets plus liabilities. This is the area that I'd been using. This was the exact equation. This is called accounting equation, which states that whatever money you're putting in the business is called capital, and whatever you do with that money is your assets. And no, this is also wrong. This has to be like capital plus liabilities is equal to assets. And this is one of the beautiful equations. And how does it exactly work? Let's talk about that even. Just erasing everything, and this is where you can see it. First thing is called capital, second thing is called liabilities, and the third element is called assets. This is accounting equation. Here the capital is the money which the proprietor puts in the business. Liability is the money of outsiders. Outsider people are also responsible for this. These are outsiders. And while assets refers to, okay, if I wanted to buy, for example, I wanted to buy a machine. For that machine, I needed 10 lakh rupees, but I had only 5 lakh rupees in my pocket at that point of time. So I paid for that 5 lakh. Then, for remaining 5 lakh, I asked my friends, my family, and even the bank for that. So there I received that 5 lakh more. And then I purchased that machine. So this is where whatever money you put into the business is basically used in the business, and it can be shown in multiple areas. It can be shown as a different asset. There can be multiple areas to see. Personal use transaction has to be reduced then. That is the amount that would be reduced. Okay. Ankit sir, I think that would be there on the website then or the app. I think you can check it out. It would be visible there only. Or maybe it would be, I think I'll ask anybody if there's a particular area that you can find there. It is given in the, okay, this is only the playlist. So what you can do is you can go to our website or the app. That would help you. There you can find out the details. Okay, now let's move on to this question. This question is a little difficult to understand because it is written in that way. If a purchase return is of rupees 94 has been wrongly posted to the debit of the sales, that means there's a purchase return. Purchase return, that means we have given back those goods to the person, right? It should be written here, and the particular person to whom it has been written should be written here. But what have we done? If purchase return of 94 has been wrongly posted to the debit of the sales return account, that means there's a sales return, then there is also a then at the same this has been written as sales return, but had been correctly entered into the supplier's account. That means this particular person is sorted. There is no mistake when we were not noting down the scenario of the creditor. The total of the trial balance would show. Now the point is it has been treated as a sales return on the debit side while it should be a credit item. What would you do with this? So I'll review to it then. Think I'll be able to respond by tomorrow because we have a class tomorrow even. So that is what I can do. Otherwise, I'll ask if there's anybody they can ping it in this particular pin it in the comment section only. Now, what would you do? The point is, the sales return area is now, that is, if I prepare the trial balance. Now, let's take the trial balance there. There's a mistake. First of all, this 94 is not shown on the credit side. Secondly, it has been shown on the debit side. That means the debit side is way more than the credit side. The exact mistake is there. So, in this mistake, what is exactly happening is there the sales return is basically shown here right now. Sales return is shown here. If this is a sales return is shown on the debit side. There it is 94 rupees more than the credit side. So technically this part has fallen short. 94 here is added. This 94 has to be first reduced and then 94 has to be recorded from on the credit side. That means this side should be doubled by this amount. It should be doubled. That's why the entire process says that sales return is debited. The sales return is of rupees 94, which is currently debited. Now, this debit item has to be first credited, and at the same time, that means this particular mistake has to be nullified. Till the time you don't nullify this mistake, it won't work. And secondly, you will have to record that 94 rupees, which you didn't record as the purchase return. So there are 2 points. First of all, you have to record the sales return and you'll have to record the purchase return as well. You will have to nullify the sales return and then you'll have to record the purchase return. That's why it comes out to be the point where the debit side is double of the credit side. Now, among the financial statements, the profit and loss account is prepared for a period of 1 year by the following: accrual concept, periodicity concept, business entity concept, or none of the above. A specific state concept which is responsible for preparation of the P&L accounts, which is responsible for dividing the entire life of the particular business into 1 year gaps. The correct answer here would be the periodicity concept. This particular concept says that every year it's better that we divide the entire financial life of the particular business into different years so we can look forward. It's just like if we have to read a book, we do not read the entire book at once. There's nothing like it just goes with the flow. There are different chapters, there are different topics, there are different subtopics. It becomes easier to read now psychologically. That's how we read the business as well. We divide into small years and then these bits can be dealt with individually. So the correct answer is the periodicity concept. I'm sorry. Now comes the next question. The question says that the depreciable amount plus the residual value of a fixed asset is equal to, is it the depreciation expense? Is it the accumulated depreciation? Is it the cost of fixed asset or the future economic benefits of the asset? How do we define this? The depreciable amount, that means this particular asset can be max depreciated by 20,000, and by the end of this particular time period, by the time it would become completely depreciated, that particular asset would fetch us maybe 2,000. So in this case, what would you say that is this particular total? This particular total is the cost of that fixed asset. In the fixed asset, there are two parts. One is a depreciable amount, and one is whatever scrap we'll get after the particular asset has been used for entire life of that particular asset. So that is this scrap value or the salvage value. Which of the following limitations of accounting states that the accounts may be manipulated to conceal the vital information? There are certain things. See, in the accountancy area, there are many frauds which have been happening in the at the international level as well as the national level. So there are certain things that has been happening that limitation has led to these scams that are happening every single day. So that is, accounting leads to window dressing. Accounting is not fully exact. Accounting ignores price level changes, and accounting ignores qualitative concepts. One, two, and three. These things really do not make a very um, major chunk of the manipulation parts. The manipulation is basically affected by the window dressing. Window dressing is like you have kept something on the window, but it looks very flashy and looks very pretty. But as soon as you enter that particular area, you realize everything that was pretty was just at the window. The entire area wasn't tidied up. That means only the window seems to be good. That is something which the organizations does as well. It would clean it would keep their areas wherever that people can seep through. People can see through that particular area. That particular area would be kept in such a good way that people will think, oh, this is a good company. We can invest. But at the back of it, the entire series of their scams would lie. So that is why this particular window dressing has led to many scams. Question number 7. It says the total revenue from operations was 9 lakh. The cash revenue from operations was 3 lakh. The debtors was of 1 lakh. Bills receivable 20,000. Trade receivable turnover ratio. This particular ratio is called TR ratio. That's one of the names through which I used to learn it. That is total trade receivable turnover ratio. How do we define it? It can be defined as net credit sales divided by average debtors. Now, out of 9 lakhs, I can see 3 lakh belongs to the cash revenue from operations. That means the remaining, if the total of the sales can be divided into two parts. One is cash and one is credit. So if it is done with the cash, so there's not there's the cash one is already done. So the credit one would be 9. This was total 9. This was 3 lakhs. So this would be the remaining 6 lakhs. And the debtors were of 1 lakh and the bill receivables were of 20,000. So basically what comes here in this area is that in these kind of questions, if nothing is specified, then this particular thing, the closing values, they are treated as average. This 1 lakh plus this 20,000 gives us 1 lakh 20,000. So what would be the answer here? The correct answer here would be 5 times. So this is the entire question being solved for you. That means if there is a total of 9 lakh rupees as a revenue, this means that the remaining cash, when deducted from it, the actual would come out to be 6 lakhs. This is your credit revenue from operations. And we just divide this part. Whatever comes out is in times. That means how many times in an year the people who were supposed to pay us, they have sold them goods and have received back the money. Which of the following transactions will result in higher balance in the bank column of the cash book in comparison with the passbook. This is from the BRS, Bank Reconciliation Statement. The check issued but not presented for payment, interest allowed by the bank charges entered twice in the cash book, and checks paid into bank for collection but not yet credited. Now, the point is where the point where you will find more of cash book balance than of passbook balance. This is the question which results in higher balance in the bank column of the cash book. If the interest is allowed by the bank, that means in this case, this would be like the passbook shows more money because we just received money in the bank. So this is not the case. Now let's take this point. Bank charges entered twice in the cash book. Bank charges reduce your balance. So this would mean that you have deducted the bank charges twice. This is not the scenario again. The checks paid into bank but for collection but not yet credited. Now this can be the point why there's one more check issued but not presented for payment as well. Now, in this point, what we can do is both of these points would qualify for it as such. Let's talk about these both points. Check issued but not yet presented for payment. Okay, now this point number A is a situation where I have given money to someone. I thought that particular person has taken out money because I have given him the check. I would be of the view that he would withdraw the money very soon, but he didn't. So basically, the passbook balance is still more here. That means this would not qualify. Our cash book balance shows that when I gave the check to someone, I thought this particular person will remove the money or will withdraw the money very soon. So I just deducted that balance from the back and from my cash book, but that particular person didn't go to the bank to pay the check. He thought that maybe there are certain holidays, let's wait till that time, then I'll go. Because normally a particular check is valid for 3 months. Excuse me. Now the point is that the checks paid into the bank for collection but not credited. Now this is the point where there's a check that has been given to the bank. That means I had a view that okay, I am receiving a check. Now this would cause an increase in the cash book balance. But in actual, passbook has no clue about it. That means in this case, our cash book balance turns out to be more. So that's the point. That is D. A company offered 50,000 shares of 10 each at par payable for rupees 3 on application, 5 on allotment and balance on the final call. Applications were received for 60,000. This was basically a pro rata. The excess application money was to be adjusted on allotment and call. How much amount will be transferred from the share application to the share allotment? Basically, people have applied for 60,000 shares where you can give only 50,000 shares to them. Technically, the excess amount of shares that I can see here is 10,000. Okay, now I think it would be visible in a better way. Look at this. If we received shares for 60,000 and we can give them only 50,000 shares, that means people have paid more for around 10,000 shares. For those 10,000 shares, we have received 3 on application. That means we have received 30,000 rupees more at the time of share application. How much amount will be transferred from the share application to the share allotment? From the share application to the share allotment, how will we deal with that? We'll deal with that whatever money we have received in advance, this particular amount will be used in the area of share allotment. Now, the share allotment can only be of 50,000. When a company issues shares, it cannot exceed this authorized share capital, isn't it? So basically, it would be 50,000 into 3. That means in terms of application, we have received 3 and on allotment, we have received 5. So it is like 2,50,000 is for share allotment. If 2,50,000 is for share allotment, then we just reduce this 30,000 here, and whatever is left is 2,20,000. That is the amount which these people will have to pay for that particular amount. So it comes out to be 30,000. Here, all you can do is note down for the pro rata, always note down the applications on this left hand side, and whatever we can authorize them. Authorized or subscribed capital. No, it is better that I write it as subscribed capital. This is the application number of applications that we are receiving. And this is the subscribed capital. Right? That's how we note it down. Okay, the last question. When finalizing the current year's profit, the company realized that there was an error in their valuation of the closing stock. They realized that there was a trouble in terms of the closing stock of the previous year. In the previous year, the closing stock was valued more by 50,000. That means when we talk about the previous year, the closing stock was more. I think we have discussed this question. Maybe the question didn't change. Okay. Now the closing stock was more by 50,000. In the next year, this closing stock becomes the opening stock, right? So here, last year's profit was more. Overvaluation of profit was there. In this particular year, there is an undervaluation because the expense side would be more. As a result, what would happen? The previous year profit is understated or overstated. Previous year profit has basically received more income. If it has received more income, it would be overstated, while this year it would be understated. It would be B. The correct answer is B. If you haven't reviewed our JAIIB and CAIIB courses yet, then what you can do is our classes for CAIIB, BFM has started bilingual, while JAIIB, AFB has just started today. That is on 16th of August. This is for English medium and this one is for bilingual. So if you haven't reviewed our courses yet, then kindly go ahead and use the code 5Y541, and currently you can avail a discount of 81%. So kindly go ahead and check it out on our website as well as on our app for further details. And the batches have just started, so it's always best that you can take up those batches in time so you can have those batches in the live forms, and that would help you to interact with the teachers in a better way. Along with that, you'll be able to see the study plan for these batches as well, so you can see what topic is being covered on what day. So keep on learning and keep on growing, everyone. Thank you. We'll be meeting tomorrow at 7:30. Thank you.